Howdy, Jacob here. Today we're looking at Dun and Bradstreet Holdings Incorporated, 5.2 billion market cap, 8.6 billion enterprise value in the professional services industry. They provide B2B data and analytics globally. Founded in 1841. Wow, been around a minute, huh? Growth is not bad. 2017, 1.7 billion to 2.3 billion 2023. Big growth 2020 and 2021. Not as much outside of that. Gross margin going down, but 65% is all right. 6 to 8% of the operating margin. Recently paying a dividend. It's a 1.7% yield. Not really any return on invested capital here. Looks like they don't have any R&D. A lot of the money is going to split almost evenly between cost of goods sold, sales, general and admin, and other expenses. Other operating expenses. Balance sheet has 188 million cash on hand, 33 million short-term debt, 3.5 billion long-term debt. That is immense. At 3.5 billion long-term debt in relation to free cash flow of less than 350 million is over 10 times. So they have an immense amount of debt. I'm concerned about that. They made a huge acquisition over here, and free cash flow didn't change. Their cash from operations went up 150 million, but so did their capital expenditures. So pretty big acquisition for not a lot of cash. So if you buy some for $6 billion, I'd really like to see that free cash flow jump up 600 million. Not even close to that. So use of cash is reinvesting, debt pay down, and then a little bit to the dividend. So that dividend is very reasonable payout. 80 million of an average of, let's say, 250, 300 million. It's not going to be a whole lot of that, maybe 25% or so, but a lot to acquisitions, reinvestment, and then a little of the debt pay down. So this is going to be interesting. I'm going to say a lot of money goes to debt pay down for capital allocation here. So growth is going to be very lackluster because, again, they're going to have maybe a little bit of acquisition and reinvestment, but mostly let's do 12 for PE due to enterprise value being quite a bigger market cap. And that's even assuming, I'm assuming 30 to 50% goes to, of capital allocation goes to debt reduction. So that dividend is still going to be there. I'm fine with that. I'm not changing it though. So hopefully it goes from, the current, let's say 25% down to 15, 20% of allocation at the end of the period. Maybe a little bit extra growth for, damn, they really have not made any earnings, huh? They have made cash flow though, so I do feel better about that. Maybe let's do 8 and 10. I don't know. With the share change of don't buy back any shares, 74 million in stock-based compensation, increase it at 1%. Yeah, we're not really close here. So I don't know. There's too many other businesses that look a lot more attractive to do some deeper dives in. This would not be one until it got to a stupendously cheaper price than what it is today. Hope you enjoyed the video.